Coming up in today's show, the Dow closes up for the 11th straight day, the 100-year-old buy signal that just flashed, Steve Eisman says the market's going to continue melting up, US economic growth slows, AMC rips higher on the back of Barbie, Tupperware shoots up 75%, and foreclosures start to jump around the country. Welcome back to the Click Capital Daily Show, everybody. I hope you had a great weekend. My name's Jared. I'm going to run you through all the most important news, data, and charts from the markets today. And so another mixed day to start the week off on Wall Street. The winning sector today was energy on the back of crude shooting up. We're also seeing continued gains coming out of financials, and mega cap tech popped up as well. And just a quick look at economic data we got out today. We got some purchasing manager index coming in, the PMIs, and in America, the manufacturing PMI came in a little higher than expected at 49, but still in contraction territory underneath 50, and the composite and services PMI still just above contraction territory. However, looking across the globe, we also got PMIs out of the UK, with their manufacturing much deeper in contraction territory at 45. Even worse across the Eurozone, with their manufacturing PMI at 42, and deeper again in Germany at 38. France as well at 44. And we can still see services out there in the Eurozone and Germany still expanding, but they're contracting in France. And so there's weakness across the globe in manufacturing is still contracting in a recession. And just like we're seeing out of China, there's just not as many goods being produced right now. But if you've noticed, the cost to go out and have a meal is still increasing. That's because we've got sticky inflation, especially core inflation, still around 5%. And that's why the Fed's almost certain to jack rates again this Wednesday. And with the market putting on an almost 20% chance they'll hike again in September, if not 30% chance we'll get the hike in November. And that's been increasing week by week now. We can also see that in the Fed-sensitive US government bond 2-year yield, ticking up to 4.92 today, and not too far away from multi-year highs, just above 5% here. Same with the December Fed Fund futures contract, still implying a rate by Christmas at 5.4, and that too is climbing up to all-time highs near 560 just before Silicon Valley Bank happened. We can also see the spread of inflation-protected treasuries versus regular treasuries ticking up again today, and the market may be reassessing its expectations of inflation and starting to price in that we're not just going to go straight down to 2%. Like the stock market is pricing in. But technically speaking, we do have strength in the stock market, with the Dow Jones Industrials the leader again today, moving up for the 11th day in a row. And just taking you out to a weekly chart, you can see we've done a clean break above this resistance zone we've been watching. And the strongest sector of them all is the industrial sector, breaking out to new all-time highs. And one of the oldest signals in technical analysis, Dow theory, first invented by Wall Street journalist Charles Dow over 100 years ago, has just flashed a buy signal in the market. And that's when we see both strength in the Dow Jones Industrials and the Dow Jones Transportation Index to new 52-week highs. It kind of confirms a broad rally, and the theory behind it is if the economy is doing well and consumers are buying goods, transportation firms should also be doing well as long as they are tasked with moving those goods. And so we have both of those indices breaking out now, and research has found when that happens, the forward returns for the broader market were above average. The S&P 500 delivered an average 12-month return of 10.5% and an average gain of 6.6% over the next 6 months. And we can see that here in this chart, with the returns especially being strong in the transports. And just looking at a daily chart of the transports ETF, we can see that recent parabolic strength and similar price action in the industrials as well. However, the price action technicals doesn't exactly line up with the fundamentals, because we recently just got earnings from CSX Corporation, one of the largest railroad operators, and they actually missed on earnings, and guidance from their CEOs was that they'll see a de-acceleration in the amount of goods coming in and being required to move around as a lot of companies destock, and the de-acceleration going on in China and manufacturing across the world. However, with this price action in transport stocks, stock market's always future looking 6 to 12 months. So the stock market is pricing an uptick in economic activity over the second half of this year going into Christmas. And if we don't get that, that could be quite the correction in these stocks, because up until the last month or so, it was really the mega cap tech just pulling the market higher. Now we've seen a bit of participation in other sectors like industrials and transports. Also financials starting to perk up, and a little bit so in energy stocks as well. And we've even got some of the brightest minds in finance, like the Big Short billionaire Steve Eisman, saying stocks will continue to melt up as long as there's no evidence of a recession. He said a lot of people out there are conservatively positioned, and he doesn't seem to think any more hikes from the Fed's going to damage that. He said there could be as many as 3 more rate hikes this year. He said it could affect growth stocks, but he said if the past is any guide, after the Fed raises rates, rates, Powell come out and be dovish. Also on the other side of the coin, the US economy hasn't started off with the strongest summer, with July seeing an unwelcome combination of slower economic growth, weaker job creation, gloomier business confidence, and sticky inflation. That's because the US economy grew at the slowest pace in 5 months in July, a pair of S&P surveys showed, and they pointed to weaker conditions later this year. And so we know manufacturing is contracting, but the large service side of the economy is keeping the US forging ahead, but it might be losing some steam here. And the Fed's expected to raise rates again on Wednesday, so we're still yet to see how these higher rates will play out through the economy. We've also got Main Street Research saying the market's FOMO-driven rally is unsustainable and most AI stocks are still bottoming. The firm pointed to record low stock market volatility, a sign investors are chasing the market. Said the recent market strength has been driven by FOMO, both retail and institutional investors not wanting to miss out. He doesn't think the daily grind upward in stock indices is sustainable, amid the possibility of mixed earnings reports over the next few weeks and another Fed hike. He also said the Fed is likely to issue hawkish guidance, and I think that'll be a big thing on Wednesday. We all kind of know the hike is coming. It's what they say they're going to do in their next meeting in September. Are they going to give indication that they're going to go on pause again, or are they going to lean a bit more hawkish and say that they need to do another hike before Christmas? And if they get more hawkish, that may exacerbate a sell-off in tech growth stocks. We've also got the former Merrill Lynch chief economist saying there's no chance we're having a soft landing. And he also gives the Fed no credit and no mercy. He's favouring bonds and rate-sensitive stocks, including utilities, staples, and REITs. And like he said, you don't know an economy is in a recession until it's in one. So there's no chance of a soft landing in the context of the most aggressive tightening by the Feds since the Paul Volcker years. And he said the banks are rapidly building liquidity, which is telling you that behind closed doors, they are more concerned than they're letting on. And that's true. The higher the rates go, the larger these unrealized bond losses on all these big banks' balance sheets are. And that's okay if all those bonds can be held to maturity. However, if we do see a bit more of a spillover in the banking system, and if a recession causes a lot more bankruptcies, then that could become a big problem. One of the biggest movie releases in recent years has been Barbie this weekend, which is setting a lot of records, including with AMC, which saw its highest ever download of its theaters app and had almost 8 million go and see the movie around the world this weekend. And that's their biggest and busiest weekend since 2019. And on Saturday, they had their second highest food and beverage day in the US. And we also had news out Friday afternoon with a surprise court setback after the judge rejected plans to turn its APE shares into common stock of AMC. And we can see that in the price action of AMC, one of the biggest days we've had in quite a while now. Finished up almost 33% on a huge volume of 255 million shares. And we continue to see more action in the meme space, including Tupperware stock today. And there was no real news out from the company or the stock or any press release or new business. It just appears to be the random start to a short squeeze. And it was quite big. We finished up over 75% today on huge volume, over 130 million shares traded. And we're starting to see pockets of spikes in foreclosures around the country, with them overall jumping 13% in the first half of this year. And like I've been saying, this is just another sign consumers are already feeling the pinch, even though we have record low unemployment rates. And a big reason for that is the cost to service the debt with these increasing rates and how overvalued Western property markets are relative to average incomes. And we can see affordability now is even worse just prior to the GFC peak in 2007. When the average homeowner was spending 39% of their wage to service their mortgage, it's now at a record high of 40%. And this is pretty much the same story all across the Western sphere, Canada, UK, Australia, New Zealand, and America. And we're not even done with rate hikes yet either. It was a quiet day in the options market to start off the week as per normal. Just under 36 million contracts traded, 57% of them calls, which is keeping the fear and greed index in what seems like a permanently elevated position. And there we go again on the dark pool index, swinging lower, down to 45% and continuing to diverge from the market. Same with corporate insiders, just showing no interest in buying their own stock here this last month. And back into the charts, we continue to grind higher on this low volatility. We only really saw a little bit of weakness in the Nasdaq equal weight and microcaps today. Everything else was pretty much up across the board, including international stock indices. You can see a little bump up in the VIX 9-day to 13.4. Market may be just getting a little bit ready here for the Fed's interest rate decision on Wednesday. And like I said, we'll be paying attention to their guidance and outlook for September. We've got breadth seeming to stall here, 80% of stocks above their 20-day average, and a little bit of a pullback in the stocks making new highs today. We've got growth versus defensive sectors sitting right at the 50-day VWAP, and the growth versus value stocks continues to lose a little bit of ground. Still got positive momentum in high yield bonds versus treasuries. However, these higher rates is keeping downward pressure on TLT, which I think will come back down and test this support zone just below $100. Dollar perking up a little bit today to above 101, and there's Bitcoin looking to be rejecting off this big 31,000 resistance zone. Just briefly touched its 50-day today and had a little bounce. Strength in the dollar isn't stopping commodities from continuing to rip here. Looks like we've done a solid bounce off this support zone. Still got gold and a little bit of a soft pullback, and there's crude ripping up to multi-month highs just below $79 a barrel. Agricultural commodities breaking out to a multi-month high, and this is going to continue adding upward pressure on food prices and inflation overall if this trend continues. And again with wheat up 8.6% today, floating with multi-month highs. And another strong commodity, orange juice, just broke out to all-time highs today and it's been on an absolute tear this last 2 years. Over to stock sectors, got the cannabis ETF coming back down to this big support zone. There's obviously some people out there that think the Safe Banking Act is not going to go through. And to be honest, I wouldn't be surprised if the politicians can't get it done again, even though 90% of the country wants it done and has done for the last couple of years. The reality is we live in a corporate-sponsored democracy, and a lot of these politicians are just in the pockets of Big Pharma, unfortunately, which doesn't want cannabis to be legalized as it threatens their pain management business immensely. However, I'm still holding out some hope that Biden might not have forgotten that he made a campaign promise to legalize cannabis. And with just a little over a year to the next election, hopefully he can do the right thing and get that legalized and help this industry survive and possibly thrive going forward. It's a bit mixed throughout the stock market, a lot of green. In some sectors like energy and the financials, regionals had a good day, up 2.5%. Then we just saw a bit of a pullback in jets after they've been on a tear, and a little mixed in the defensive utilities coming off. Staples ticking higher, and healthcare having a little pullback in this overbought area. And just looking at our sector trends table, we can see there is a little bit of weakness in the immediate term trend here. However, we've still only got one sector below the 50-day biotech and one below the 200-day regional banks. Other than that, all sectors are still above their 50-200 day. Got BlackRock continuing to tick higher up into this big resistance zone. JP Morgan ripping higher again today, 2%. And over to mega cap tech, Apple a little soft, same with Microsoft. And that's the other big news we're going to get out this week is Microsoft and Google earnings tomorrow. After close, so that should get the market moving. And we did see those negative reactions to Tesla and Netflix, so we'll see whether Microsoft and Google can hold up after giving out their numbers. There's a look at NVDA just having a little pullback. Tesla having a bit of a nice bullish engulfing pattern here after dipping below its 50. And we're seeing Meta cool off a bit as well. We've got earnings coming out of them on the Thursday. Had been tracking really well after Zuck launched his latest copycat app, Threads. However, like we're already seeing in the data, their usage is dropping off very fast. And that just initial kick and test out by a lot of people is reversing course. And they've actually seen a 70% decline in the number of daily active users from their first week. As a quick look across the meme space, a bit mixed out there. And also active today was Spotify, with shares falling almost 5% going into their earnings tomorrow. On the back of news, they're increasing their prices. We also got Chevron trading up 2% on the back of their good earnings on Friday and management reshuffling. And those beaten down telecoms continue to tick higher. AT&T up 1% and Verizon just a little bit higher. And continued positive price action in the regionals, even the most vulnerable ones like Pac West up 8.5% going into earnings tomorrow. Western Alliance up 3%, and others like Zion and First Horizon doing well. In addition to the big guys, Bank of America, Citi, Wells, and Charles Schwab. Still a nice short-term uptrends here. There's a look at our S&P 500 oscillator, currently sitting at 55.38. And creating one of the biggest bearish divergences we've ever seen on this indicator and the market here. Which is similar to other things like the global net liquidity model, also showing the biggest ever bearish divergence with the market. Also got divergences with the government bond yields. Here's a chart of the 10-year government bond yield inverted. So when this goes lower, the rate is going higher. So we can see 420 here and up to 340 here. If I just overlay this chart with the S&P 500 and just zoom out, we can see there has been a bit of correlation. When rates go up, normally stocks go down as they don't like that. Then when rates go back down, stocks go back up. You can see that kind of loose correlation we've seen there with rates inverted and the stock market. However, look over the last couple of months. We've seen rates track higher after we shook off all that banking crisis fears and the focus is back on sticky inflation and the Fed still hiking rates. But the stock market's just done a parabolic drive higher and completely ignored that. Some other divergences we're seeing in the market is between the spread of copper and gold, which is a good measure of economic growth, as copper is a lot more sensitive to economic growth. It's used in a lot of industries and to produce a lot of things, whereas gold's more of a safe haven, conservative asset. And so we can see that this year there's been largely a downtrend in the copper gold spread. And again, if I just overlay this chart with S&P 500 and zoom out a little bit, we can see some loose correlation. When the spread of copper gold goes up, so does stocks. And then when it came down, so did stocks. However, like with government bonds, the last couple of months we've seen that spread come down, and again, stocks completely ignored it. Similar story again in high yield corporate bonds. They're still well off their highs from February this year, and we had some correlation in the stock market last year really well. Stocks were correlating with high yield bonds. However, again, the last couple of months, stocks and bonds, big divergence. So basically, the stock market is diverging from just about every other market out there, especially American stocks, which have been a lot stronger than international stocks. And that's largely thanks to the Magnificent Seven, as they call them, those big guys, Apple, Microsoft, NVDA, Tesla, Meta, Amazon, and Alphabet, on the back of AI hype. So is it a case that the stock market is right and all those other markets are wrong? Or are we due for an epic correction going into the back end of this summer when we typically have weak seasonality in the stock market? And so we'll just need a catalyst for that, either an unknown surprise, maybe some real hawkish speak from Jay Powell, or some disappointing earnings, but anything that's going to cause a spike in the VIX from these really low depressed levels could unwind that parabolic NASDAQ trade we've seen all year. And maybe when it comes, it could come really viciously, and we may get a surprise 4 or 5% down day. However, as long as we stay above the 50-day VWAP, we could continue grinding higher, as it's very hard to time tops. That's all for this Monday. Thanks for sticking with me. We've got another interesting week in the stock market with Microsoft and Google earnings tomorrow, going into Fed decision on Wednesday. And we'll see whether that can get a bid in volatility or if we just continue grinding higher. Thanks very much and see you again tomorrow afternoon.